let's move on. It's a roaring market at our hands right now, but let's try and analyze what this Fed rate cut, which has been the big trigger today for world markets, what does it really imply for the financial sector here back home at large? Let me welcome on board Santanu Chakrabarti, India analyst BFSI at BNP Paribas, joining in on the show right now. Shantanu, hi, morning. Good chatting with you. With this interest rate cut of 50 basis points, firstly, do you think India is likely to follow in the October meet?
Thank you for having me. Yes, I think India is going to follow at least a part of the rate cut. And the reason we are expecting that in this quarter, if you look at even the RBI governor's comments just a few days back, he made a point to emphasize that the regulator is looking for monetary policy decisions at the longer term inflation trends rather than a blip here or there. That creates, and that in line with what has happened in the US, creates the environment where it is probably odds on to expect that the rate should be cut. We are building in already, and we have been building in even before this development, a rate cut of 25 basis points in the last quarter of the calendar year.
Okay, let's get in a sense as well as to what the outlook is from individual banks as well. For example, an AU Small Finance or an IndusInd Bank, they have a higher share of the fixed rate loans. Do you think that they are perhaps at an advantage compared to others?
For sure, at least in one dimension. See, there are two effects of a rate cut. One is on the asset side, the other is on the liability side. On the asset side, as you can understand, your mortgages, which are repo linked, and overwhelming percentage of corporate exposure will get repriced almost immediately, right? So that is a clear vulnerability. To that extent, your argument of who has the highest amount of fixed rate book is completely valid in terms of insulation of said earnings to rate cuts. But there is a second aspect to this as well, which is the liability side of things. Now, of course, liability repricing or deposits repricing is a much more time-consuming, slower process than assets. But in terms of both mix, in terms of deposit pricing, how much of CASA can be mobilized, etc., that's another tailwind as well. So while one set of beneficiaries are names like IndusInd Bank, do not forget about other names like HDFC or Axis, where the liability side benefits, even though they may not be very dramatic right off the bat, essentially ensure that from coming off, a bottom right post the rate cuts, margins can gradually start to inch back up a little bit or at least find stability. So there are two aspects to this.
Yes, there are these two aspects to watch out for. But what about the aspect of deposit growth? Because there has been that war of deposits which was underway. And if the rate cut cycle does begin, there might be a shift towards further into mutual funds or equity markets and the likes, because deposit saving won't be as profitable. Do you see a further worsening of this deposit war there?
So one of the myths we have tried to kind of address in our current research report, which was published last week, is that, look, allocation of monies towards capital markets cannot fundamentally change the deposit flow of the ecosystem. If I take 100 rupees out of my account and buy stocks with it, that 100 rupees goes into the seller's account. The only way, the total money supply and therefore deposits in the country can change is either through the external account, which is capital or current account, credit creation or destruction by the system, as well as what RBI does in terms of the open market operations, the extent to which RBI's balance sheet expands or contracts. And that's about it. So if you analyze why money supply or deposit growth in the last 2 years has not kept pace with the amount of credit that has got created, it becomes very clear that partly it is because of the external account where capital flows have not been that strong, but mostly is because RBI has gone from maintaining an excess liquidity situation into a liquidity shortfall. So on a net basis, RBI has extracted liquidity. And the moment in an easier monetary accommodation environment, the RBI reverses this policy, it is pure arithmetic that the mobilization of deposits will be along the lines of credit creation.
Santanu, you were just alluding to an AU small finance, IndusInd, etc. Tell me how the rate cuts you think are going to impact the deposit rates and deposit growth according when it comes to, say, SBI in specific. We were talking to Mr. Sethi recently. He highlighted that the bank's CASA ratio is going towards pre-COVID levels. For the last few quarters, the entire banking industry has faced pressure when it comes to CASA deposits. So analyze some of these large PSU banks for us.
Right. So, picking up on the CASA argument, this is a very valid argument. So, even if the previous argument that I made related basically to the total amount of deposits, but what we have been seeing is that what has been mobilized within those deposits, it's been overwhelmingly fixed deposits. As fixed deposit rates start to come back down, the gap between savings account rates and FD rates as they come down, you'll see some migration back from fixed deposits into savings accounts. Now, obviously, the harbinger of that migration will not be large banks, but some of the smaller banks where sometimes some of the larger ticket savings account rates look almost like FD rates and even higher than some of the larger banks. So that's where the migration starts back. But the entire trade that you have seen, where a lot of savings account money has moved into fixed deposits, for example, in the case of Kotak, in multiple other cases, that trade will start to reverse. And the current account part of the equation relates directly to the receivable cycle for the greater trade ecosystem of the country. Now, if liquidity, at the banking system level has been generally kept in a deficit to try and manage inflationary impulses, what that means is the velocity of money and the receivable cycle, the turn on the current accounts has also been limited. So as the environment eases, you will see current account money also start to move back up. So while SA recovery is more a monetary phenomenon, as far as we are concerned, current account recovery, the recovery of the growth is going to be more a function of the liquidity in the overall system and the confidence that we see in the money markets.
Net, taking all of this into account, what's your pecking order within the sector?
So HDFC Bank continues to remain our top pick. Our second pick is ICICI, followed by Axis, and then we get to SBI. So, but within this, what we have to keep in mind is HDFC and Axis are the most sensitive from the liability side on as far as the rate cuts are concerned, while IndusInd is perhaps most sensitive on the asset side. ICICI seems, although it's second in our picking order, seems to be the all-weather pick, where the earnings trajectory is not that dependent or sensitive to the way rates are flowing.
All right. Thank you so much for giving us an all-round picture on private banks, public banks, as well as what the outlook is in terms of the impact of the interest rate cut.
If you like this video, then like, share and subscribe to ET Now.